The Reserve Bank's Monetary Policy Committee will be announcing yet another massive increase in the interest rate. The market expects a 50 basis point hike, but there are some who actually believe that the increase could be as high as 75 basis points. So for what this means for the property sector in particular and what this decision has implications for, we are joined by Carl Coetzee, who is the CEO at Betterbond. Carl, thank you very much for joining us. Carl, let's start here. COVID-19 led to massive cuts with the country seeing the lowest rates in decades. Let's start by talking about how this had an impact in consumer decisions when they were buying property, because that is something that the mortgage market looks forward to in terms of how they are going to actually buy or not buy.
Xolani, you are 100% correct. And we saw, during that pandemic, we saw a 30% cut in our interest rates. And what that has caused is far more people in South Africa could then afford a home. So the affordability of consumers were much more at that 30% reduction in interest rates. And we saw quite a bit of first-time home buyers coming into the market now being able to afford. And the property industry really had the biggest boom it's had since, before 2008, in this sort of year or two after the pandemic. So it was a very, very good time for the industry.
It was a very, very good time for your sector, but as you say, those decisions to buy properties were informed by the lowest interest rates in decades. Now we are moving back to high interest rates, back to the status quo as it was. How is the increase in interest rates over the past year? Have you seen it actually impacting on the decisions now of new home buyers actually doubling down on their decisions, maybe smaller properties or not even buying properties at all? How is this afternoon's decision going to impact on those decisions?
And the past sort of period where we've had the rise in interest rates has definitely had an impact on consumers and their affordability. So we do see certainly the market slowing down a little bit to what it was in the last year. But, also, if we look on the positive side of it, and I'll get into more some detail around that, but it's still lower than what it was interest rate now. And even after today's rate increase, it's still lower than what it was in the pre-pandemic days. So it's still a good affordability time, but we do see consumers having to tighten up their budgets. We know that inflation is high. So fuel prices, food prices, all of that impacting our consumer. So the house price growth in this past sort of year is slowing down. It is still growing. It's still growing at around 7%, where last year it was growing around 14%. So we see that softening a little bit in the market, which we expect. And that means, when we look at consumers and their affordability, we're saying, they're saying, listen, I can't buy this, maybe this 1.2 million rand house, but I'll buy a 1 million rand house. And that's the sort of trend that we're currently seeing in the market.
Something that we also saw between the period that the Reserve Bank had an impromptu meeting where they cut interest rates to 18 months, almost 18 months later, when the then rate hike cycle started, is that homeowners actually saved a lot of money. Some research even says that they saved even a month's worth of salary. Is that what you've seen in terms of homeowners saving a lot during that particular period?
Yeah, homeowners definitely saved a lot. Again, they saved up to 30% of their bond installment. They paid less. Unfortunately, and I think, how all our consumers are, is that you do get used to this lower sort of payment that you've had the benefit of in the past 2 years. So when it goes up, it's definitely important for consumers to go out there and make sure that their budgets, look at their budgets, make sure that there's no unnecessary spending. What I recently did, to give you an example, is, I know we're in this rate increase at the moment, and we expect the rate to even go up a little bit more in the next year. I went on to one of our calculators, and I calculated what it would be, if the rate goes up maybe by another percentage point in future, and I'm trying to get my budget in order for that. So I know when it comes, it's not such a big pinch. So that's the advice that I'm currently giving to consumers out there.
Some research also shows that we should expect between now and the end of the year, the last MPC meeting, we should be expecting at least 125 basis point increase for the next 6 months. What are your expectations for this afternoon? Because the MPC, the Reserve Bank Governor, has already said, intimated that they are expecting a 50 basis point hike, but anything could have changed in this meeting since the MPC started meeting on Tuesday.
Correct. And I think, with CPI numbers coming out yesterday, and it's much higher than we anticipated at 7.5%, I think that does have an effect on the decision today. Look, we are quite convinced that it would be a 50 basis point increase, outside chance of 0.75. So we do expect that. But then, depending on our inflation numbers and what they do, I do expect a bit of a slowdown in terms of that rate increases as we head towards the end of the year and early into next year. And we certainly hope that, and I hope that for the consumers. But I think this afternoon we would potentially see a 0.5%, so 0.5% increase. And to give you an idea, so on a R1 million bond, so if you're paying a R1 million bond, that 50 basis point increase would mean around 316 Rand per month more on your bond. And I think consumers need to be aware of that and budget for that increase in their bond installments.
And Carl, people will listen to you and say 316 rands is not a lot of money, but when you actually take it over a 20-year period or a 15-year period or 30-year bond, you can actually see that it comes to hundreds of thousands of rands. A lot of people are watching you, listening to you now, and actually are making their decisions based on what's going to happen this afternoon in terms of interest rates. If there is a 75 basis point hike, one of the big questions is, should I actually and can I fix my my interest rate on my bond? Is it a good idea? Is it a bad idea? What from your side is the way to go and what you should be considering as a new home buyer this time around?
Yeah, and that's a very important question. So, yes, I think generally in South Africa, 95% of all our bonds are interest rate linked. That has an impact if it goes up. You can go to your bank and ask for them to fix your interest rate. That's definitely a possibility. Some of the advice I could give there is the bank would fix it, depending on your circumstances, but they don't fix it for the full term of your bond. So they fix it between 3 or 5 years. It all depends again on your profile. And they will generally fix it at a higher rate than what it is now. So my advice again would be, make sure that, let's say they fix it at 2% higher than what you are currently paying. You'll pay immediately, you'll pay more, but you have stability and you can budget. But if it's only for 3 years and we don't expect the interest rate to go up by as much as 2%, then it's a financial decision you need to make sure that you make the right decision. And I would always just caution on that and make sure that you take all those factors into account when you go and fix your interest rate. But it's definitely a possibility, and the banks do that.
Carl, since we've seen the lowest interest rates in decades in the past 2 years, have we seen people actually fixing their interest rates in the past 2 years? How much of an impact did this have on their decision making when it comes to fixing their interest rate or not?
Yeah, so it was very difficult to predict. It's difficult to predict at any given time what the interest rate will do over time. I think the Ukrainian war is a very good example of it. Nobody of us expected that to happen and the impact that it would have had in the rest of the year. But let's say you were at 7% interest rate, so you got a prime interest rate from the bank and you decided to fix it at that time. Well, if you got it fixed at 2% higher, the interest rate is still, after these increases and even after this afternoon's increase, let's say it goes to 8.25, and I'm talking about the prime lending rate here. It's still, so it's still lower than the 2% that it was fixed. So it's always a very difficult decision to make because you must sort of have this crystal ball on what interest rates will do. in the next couple of years, and that's always very difficult to predict. If you ask me, my personal opinion, will the interest rate go up massively? I don't think so. I think we will see gradual increases up to a point until inflation is intact. So it's always a difficult decision to make. And as I say, you must go to your bank, understand what they would fix it at, and then trying to understand what's the best possible solution for you as a consumer.
Another important question that we always hear is when you're considering buying a property, what should your consideration be in terms of your income? So how much of your income should you put aside in order to actually say this is for a mortgage, in order to protect yourself in times of higher interest rates? As a property specialist in that area, what advice would you give people who are now considering buying property as far as their income is concerned?
Yeah, so I think, in my opinion, there's never a bad time to get into property. And even if interest rates are going up now, it is all about affordability. So my advice to consumers is go get an affordability assessment. At Betterbond, we give you a pre-approval. And in that pre-approval, you would know how much you can afford right now. And what we also do is we give you a range of what the interest rate will do potentially over time. And you can see if that repayment is now 8,000 Rand and potentially in a couple of years' time that is 9,000 Rand, do I have that available in my budget and making sure that you can afford that. So my advice to consumers is don't buy at the max that you can afford right now, but rather say, I want to allocate maybe 20% of my income to my bond repayment, and don't buy at the maximum that you can afford. Always make sure that there's a little bit left when these interest rates go up so that you can afford it comfortably.
Carl Coetzee is the CEO at Betterbond. Thank you very much, Carl, for your time.